Welcome to Markets Without Spin, the podcast that cuts through financial media noise to examine what's really happening in markets and the global economy. I'm Franz Amundsen. Before we dive into today's topic, let's briefly look back at episode 1, because today builds directly on it. In episode 1, we explored how today's markets are shaped less by fundamentals and more by structure. Index inflows, constant liquidity demands, automatic buying and selling, and the sheer scale of institutional money. These forces often overwhelm traditional analysis and create a market environment that behaves very differently from the one many of us grew up studying. Episode 1 was a map. Episode 2 is about the people drawing the map and why they draw it the way they do. So today we're pulling back the curtain on the most powerful and the most misunderstood tool in modern corporate America, stock buybacks. Buybacks reshape earnings, influence executive pay, drive capital allocation, and quietly redirect billions of dollars every year, often for reasons that have nothing to do with shareholders. This episode is why buybacks aren't financial strategy. They're compensation strategy disguised as financial strategy. We've all heard the familiar line, buybacks return capital to shareholders. In theory, yes. In practice, almost never. Modern buybacks are driven primarily by how executives are paid, how earnings per share, often abbreviated as EPS, targets are set, how total shareholder return measurements influence long-term awards, how vesting cycles work, and how internal incentive formulas are engineered. This episode is about incentives, the true engine behind stock buybacks. When I began in this business in 1985, chief executive pay looked completely different. Cash compensation mattered, dividends mattered, boards talked about stewardship, not peer group rankings. Today, compensation is dominated by stock, restricted stock units, performance-based stock awards, stock options, and massive multi-year packages tied to total shareholder return measurements. When most of an executive's pay depends on the stock price, the executive becomes a manager of stock price, not the business. Once you understand that shift, everything that follows becomes clear. If you want to understand corporate behavior, read the proxy statements, specifically the compensation sections. Again and again, companies say something like, cash bonuses will be paid if earnings per share grows by a certain percentage. There are only two ways to grow earnings per share. One, actual growth in profits, or number two, reduce the number of shares outstanding. One is difficult, slow, and uncertain. The other is instant, and executives control it directly, so companies buy back stock. The denominator shrinks, the number improves, even if the business hasn't. This is not fraud. It is not secret. It is simply the easiest way to hit the numbers that determine executive pay. And earnings per share is just the first lever. There's a second lever, quiet, more powerful, and even more distorting. The second major incentive is total shareholder return, a measure of how well a company's stock performs over a period of time relative to its peer group. Most long-term compensation plans use a 3-year window. On paper, that looks like long-term alignment. In reality, it creates a predictable pattern. Buybacks increase as the end of the 3-year window approaches. Boards approve new repurchase authorizations at exactly the right moments. Capital is spent to support the stock price just as awards are getting ready to vest. The public never sees this, but it is the quiet metronome of modern corporate life. Here's how the modern compensation system works in plain English. Restricted stock awards dilute shareholders, so companies buy back shares to offset the dilution. Stock options magnify upside for executives, and buybacks help lift the stock price, improving option values. Performance-based stock awards require hitting numerical targets, so buybacks become a tool to help meet those targets. Multi-year mega grants tie compensation directly to the stock price, so management has a constant incentive to support that price. That's the general machinery. Now let's make this real. Let's look directly at the language in a proxy statement filed by Salesforce, because it reveals in plain English how the incentive system actually works. The key issue here is non-GAAP earnings, adjusted numbers that remove real costs. Salesforce states clearly in its compensation discussion and analysis section, and I'm quoting here, "We evaluate performance using non-GAAP operating metrics because we believe these measures reflect better management execution." And then Salesforce goes on to explain what it removes from earnings. And I'm quoting here again, "Non-GAAP operating income excludes stock-based compensation, amortization of purchased intangible assets, restructuring charges, acquisition-related expenses, and other items that we believe are not indicative of ongoing operations." So let's explain that in plain English, and this is what most investors miss. Salesforce removes the cost of paying employees and executives with stock, the cost of acquisitions, the cost of restructuring, the cost of purchased intangible assets, and that means goodwill as a primary one, any expense the company labels as not ongoing. And now here's the moment where it all comes together. Salesforce then tells you very clearly that these same adjusted non-GAAP numbers determine executive payouts. Here is the exact line from the proxy statement. "Our performance-based stock awards and long-term compensation plans are tied to subscription and support revenue growth improvements in non-GAAP operating margin and total shareholder return relative to its peers." So read that carefully. Executives are paid based on non-GAAP operating margins, and non-GAAP operating margins exclude the cost of stock-based compensation. And stock-based compensation is one of Salesforce's largest expenses, and those expenses directly produce the stock awards executives receive. This creates a closed loop. The Salesforce incentive loop. Number one, executives receive large amounts of stock as compensation. Number two, Salesforce removes the cost of that stock from its earning metrics. Number three, removing that cost makes profits appear higher. Number four, higher adjusted profits help executives earn more stock. 5, issuing more stock dilutes shareholders. 6, to offset this dilution, Salesforce buys back shares. Number 7, buying back shares supports the stock price. Number 8, a higher stock price helps executives meet total shareholder return goals. Number 9, new stock grants are issued the next year, and the cycle begins again. This is not speculation. This is not theory. This is not opinion. This is exactly what Salesforce discloses in its own proxy statement. And here's the simplest possible summary. Once you remove the cost of paying with stock, stock-based pay starts to look like free labor. And that illusion inflates both earnings and executive compensation. This is why stock buybacks become permanent, not optional, not strategic, permanent, because the incentive system requires it. Now the part almost no investor notices. Boards issue millions of shares to executives. That dilutes existing shareholders. Companies buy back stock to reverse the dilution. The next year, boards issue new shares again. Over time, buybacks become permanent, not optional. Investors think buybacks are returning capital. Most of the time, companies are simply trying to stay ahead of the dilution caused by compensation. Let's look at a company where incentive systems played out in full view, IBM. For years, IBM publicly committed to delivering $20 of earnings per share by 2015. That single number shaped strategy, capital allocation, and executive compensation. There was a major problem. IBM's core business was shrinking. So how did IBM keep earnings per share rising? They bought back stock. Enormous amounts of it. At one point in time, IBM spent more money on stock repurchases than on research and development and acquisitions combined. Think about that. A technology company operating in the most innovative industry in the world spent more money on financial engineering than on innovation. The results were exactly what you'd expect. Revenue stagnated, market share evaporated, talented employees left, and competitors like Amazon and Microsoft surged ahead. This is what happens when executive compensation becomes the North Star instead of strategy. IBM did not collapse overnight. IBM didn't stumble. It eroded year after year, one share repurchase at a time. It decayed in slow motion. IBM shows what happens when incentives overpower innovation in a company that is already struggling, but incentives shape behavior in strong companies too, especially at massive scale. Now, let's contrast this with Apple, because Apple is the clearest example of how incentives operate at a massive scale. Apple is not IBM. Apple is a company with an extraordinarily strong ecosystem, some of the highest margins in consumer electronics industry, and a customer base that borders on generational loyalty. But here's the connection almost nobody makes. Apple has executed the largest stock buyback program in the history of public markets. How large? Since 2012, Apple has spent well over $600 billion buying back its own shares. In some years, Apple has spent more than $80 billion on repurchases in a single year. And that's more than the total market value of many Fortune 100 companies. To put that in perspective, between 2018 and 2023, Apple retired nearly 5% of the company in some individual years. Apple has reduced its number of outstanding shares to roughly 60% of what it was a decade ago, which means the company has retired 2 out of every 5 shares that once existed. Apple has spent more on buybacks than the annual economic output of most countries on Earth. Why would a company that successful do this? Well, because Apple, like every other public company, responds to the incentives built into its compensation system. Apple's long-term executive compensation plan includes performance goals tied directly to the company's stock price, rankings relative to peer groups, and share price hurdles built into multi-year stock awards. In that environment, buybacks become the most reliable stabilizing force available. They are predictable, they are controllable, and they support the achievement of compensation targets. But here's the part almost nobody ever says out loud. Even with Apple's talent and resources, the pace of breakthrough innovation is slowed dramatically. Since the era of Steve Jobs, Apple has not introduced a new product category on the scale of the iPhone, the iPad, or the AirPods. We have seen improvements, better cameras, better displays, a new chip every year, but not a category-defining product that reshapes the landscape. This does not mean that Apple's failing, far from it. But it does reveal something deeper about incentives. Apple did not choose buybacks. instead of innovation. It chose both. But when incentives compete with imagination, incentives usually win. Financial engineering provides certainty. Innovation provides uncertainty. And when executive compensation tilts heavily towards performance measured in stock price terms, even the most admired technology company in the world naturally leans towards a path that supports the stock today rather than the risk of something truly new tomorrow. And here's a perspective almost no one considers. Imagine if Apple had chosen a different path. Imagine if, instead of spending more than $600 billion buying back its own stock, Apple had paid that same $600 billion to its shareholders as dividends. That cash would have flowed directly to pension funds, retirees, teachers' retirement systems, individual savers, and everyday investors around the world. People could have reinvested it wherever they believed it would best support their own financial futures. But buybacks do something very different. Buybacks force the return to stay inside Apple, increasing each shareholder's claim on the company instead of giving them cash that they can redeploy into the broader economy. And when a company of Apple's scale recirculates that much capital into its own shares, the benefits naturally accrue to those who already own the stock: the senior executives, large institutional investors, and long-tenured insiders. Dividends distribute wealth. Buybacks concentrate it. And when the largest, most valuable company in the world consistently chooses the method that concentrates wealth over the method that distributes it, the ripple effects show up in the wider economy. A significant share of the income and wealth inequality we see in the United States is simply the cumulative outcome of companies, Apple foremost among them, responding rationally to the incentives embedded in modern executive compensation plans. Right before the pandemic, the major U.S. airlines, Delta Airlines, American Airlines, United Airlines, and Southwest Airlines, were all reporting strong financial performance. And so what did they do with their cash? They spent over 90% of it buying back their own stock. Some went even further. They borrowed money to keep stock buybacks going. Why? Because their compensation plans rewarded growth in earnings per share, outperforming competitors, and stock price thresholds inside their long-term compensation awards. When your pay depends on beating your peers over a 3-year measurement window, you do not build a rainy day fund, you buy stock. And then the pandemic hit. Air travel collapsed, revenue vanished, planes sat idle, balance sheets imploded, and taxpayers provided the rescue. The airlines did not fail because of the pandemic. They failed because they were optimized for compensation, not resilience. Stock buybacks do not increase wages, expand capacity, or strengthen innovation. They simply transfer more value to executives, senior insiders, and large concentrated shareholders. This is why stock buybacks accelerate wealth concentration, not because they're inherently bad, but because the incentive structure rewards the wrong goals. Here's the idea I want you to remember. You choose when to buy or sell your own stock, but when a company buys or sells its own stock, that decision is shaped by internal incentive formulas that most investors will never see. In today's world, those incentives reward financial engineering over investment, employees, or long-term vision. That's the buyback machine. So in episode 1, I explained the structure of modern markets. Episode 2, I revealed the human incentives operating inside the structure. Incentives always create outcome, always. In episode 3, we'll explore how passive investing has become the most powerful force in the market, how trillions of dollars flowing into index funds now shape corporate strategy, influence executive behavior, and move prices in ways that few investors understand. Thanks for listening to Markets Without Spin. I'm Franz Amundsen. See you in episode 3.